only on Bloomberg Quint.
Thanks for joining us on Parlance. This is Bloomberg Quint. I'm Harsha Subramaniam.
Good afternoon. I'm Ira Dugal. Let's get you the headlines. Indian markets extend losses for the second day. Sensex falls over 200 points, led by heavy selling in metal and auto stocks.
Dena Bank and Vijaya Bank trade with deep cuts after the share swap ratio was announced for the merger with Bank of Baroda.
Reliance Jio adds over 1 crore customers in October, even as rivals Airtel and Vodafone Idea shed users.
Fewer upgrades to new iPhones, weakness in China and supply constraints have prompted Apple to cut its revenue forecast for the first time in 2 decades.
All right, all that coming up on the show, but let's first take a look at how markets are faring. Agam is here with us for the update. Agam.
Hi. So we're certainly seeing a lot of weakness right now, considering the Nifty has fallen, coming off by as much as 0.8%, and it's inching towards the mark of around 10,700 right now as we speak. The Sensex is also down around 0.7%, about 0.5% cuts for the banking index. But the reason why the cuts there are a little less is because of the gains that we're seeing in Bank of Baroda. That said, as we mentioned earlier, with the bulk of the weakness is on account of because of the weakness in auto sector as well as the metal pack, and that is where we're seeing a bulk of the losses coming through as well. In fact, Eicher Motors for the second straight day losing out in trade, and that brings me to some of those gainers and losers. I'm going to start off with the gainers. Gains in Infratel and ICICI Bank, followed by Asian Paints, but losses again are a lot severe. So Eicher Motors right at the top of that list, down nearly 4%, followed by something like an ONGC as well as Tech Mahindra, each of them losing out over 2.5%. So there is weakness, and we're going to have to wait and watch whether or not we do see the Nifty eventually close below 10,700 today.
Well, that's the markets for you, at least on the stock side. Bond yields, meanwhile, are inching back up as investors are bracing for populism ahead of general elections. Reports of a farm relief package has brought back fears of fiscal slippage. Shubhadeep Sarkar is here of Bloomberg News with a little more details. So, cash handout being priced in?
Here, Harsha, what has been at the back of the mind of bond traders for a long time now is kind of coming to the fore. I mean, with the year ending, we are looking at a very clear chance of a fiscal slippage by the government. The fear from traders is that the slippage won't be a minuscule slippage, and there might be a substantial slippage. Already, the government was running behind on the run rate on the GST tax collections. Tax collections, according to some estimate, may top the deficit may top on GST. May top over 1 trillion rupees. That itself was a substantial reason for worry. Divestments are not even half of what the 800+ billion that the government had targeted in the budget. So here, on top of that, there's the talk of this whole talk of farm waiver, farm relief scheme. Well, while Prime Minister Modi has said that he won't go in for a waiver, but the package being walked out and the figures that are being projected in the media are sort of spooking bond traders. I mean, today specifically, bond yields rose sharply on a report that about a 2.3 trillion rupee package was in the works for bond traders, which would kind of have a combination of a direct benefit transfer and other reliefs work together. So that is kind of clearly weighing on the mind of bond traders.
Shubhadeep, thanks so much for that. Staying with the economy, new project announcements fell sharply in the December 2018 quarter. That's according to data from the Centre for Monitoring of Indian Economy. Projects worth 1 lakh crore will launch, which was the lowest, at least in the current government's tenure, based on the data that we have from CMIE. Let's find out how best to read this. Mahesh Vyas, Managing Director and CEO at CMIE, is joining us on the phone line. Thank you, Mr. Vyas, for joining us. My first question to you is just that. What and how much should we read into the data for 1 quarter, or should we look at a longer-term trend and try and draw inferences from that?
So, first of all, the new investments estimate of 1 lakh crore or 1 trillion rupees is a number that will get revised in the coming weeks. So I expect this number to go up to around 1.4 trillion in about 4 to 6 weeks, maybe 8 weeks, and that will be the more stable number. But even if you take it at 1.4 trillion and not just 1 trillion as we see now, this will be one of the lowest new investment proposals being made in some 14, 15 years. So this is really a new low. And we have seen this trend of falling new investments being more or less a continuous trend since 2015.
When you say there's been a steady decline in investment, Mr. Vyas, what do you think could be the reason? Is this is this because of waning demand, or is this a capital issue? Is this a funding issue?
This is not a funding issue. So very clearly, when we ask companies what are the reasons, and the ones who answer usually give other reasons. Funding is not an issue. The projects that tell us that funding is an issue are those which are very highly stressed companies financially already. So that's a biased answer. So I don't think funding is an issue. The problem is essentially demand. And there is a problem on demand, and that's the reason why capacity utilization, as seen in the RBI's Obicus survey, is still low. I expect, therefore, new investments to not pick up significantly in the coming year as well.
Vyas, how do we reconcile this with what we have seen as part of the GDP release, which is the gross fixed capital formation numbers? They've been showing a positive trend, and I think for the last 4 quarters we've seen double-digit growth. And while capacity utilization is still not at the kind of levels that usually spurs large private investment, it has been steadily rising.
So the GDP numbers are largely influenced by 3 or 4 lead indicators. Principal amongst them are production of steel and cement and production of machinery items. These 3 indicators play a major role, and a fairly aggressive growth in roads in the recent past has led to steel production and cement production remaining quite high. Cement prices have been low, but volumes have been good, indicating that there is good demand from the construction, at least the road construction segment. That shows up into capital formation. Whereas what we are capturing over here is a larger sentiment of all those people who are saying that we want to set up new plants. I think the larger statement is that investments are not happening, not only in terms of new investment proposals, but also in terms of completion of the existing proposals on hand. So we had seen an increase in new investments commissioned reaching up to 6 trillion rupees 2 years ago, and we are seeing this fall to 5 trillion, maybe even a shade lower than 5 trillion this year.
Precisely, Mr. Vyas, because I think if you sort of look at the stalled project data, which also CMI puts out, again in this quarter there has been a spike in the stalled project number, although I know that number tends to be volatile as well.
That is true. So this quarter's stalled project has spiked because one project in Maharashtra, a refinery, has been stalled because of land acquisition problems. So a few projects did get stalled, but this refinery was very big. I think its investment proposal was around 3 trillion rupees by itself. So this is a very big investment, but land acquisition stalled it. And a few other projects also got stalled because of land acquisition. So land acquisition is a larger reason why projects that get announced then get stalled.
Okay. Mr. Vyas, just one slightly broader question though. When you speak to large companies, their order book positions and their forecasts seem a bit optimistic than what they were last year. How does that sit with the numbers that you're seeing?
We also took notice of this increase in order book position in June 18, and that's when we did write that this looks like green shoots. It looks like there's a turnaround coming about. And the June 18 new investment proposals also did increase, but that did not sustain itself. For example, we saw in March 18 and June 18 new investment proposals go up to around 3 trillion rupees. So that was very promising. But now it's down back to 2.5 or 1.5, that level. The information we get from CapEx companies that their order book positions are improving is actually a reflection of very good progress we're making in road sector. So many of the listed companies are finding traction because road investments has been increasing very well. And this is very, very different from what is happening to the rest of the economy.
Mr. Vyas, if one looks at both the new projects data and the stalled projects data, is there any shift in trend in terms of the contribution of government and private projects, both in terms of new announcements, but also whether more government projects are now getting stalled compared to earlier?
So the refinery that got stalled in Maharashtra is a government project. It was announced by the Ministry of Petroleum and Natural Gas, and that is stalled. Government projects do get stalled. There is a project there's a furniture hub in Kochi, which in Kalamassery in Kerala that also got stalled. So all kinds of projects do get stalled. The share of government projects in projects getting commissioned or announced has been increasing, and that's largely because of the road sector. But for the rest, stalling can happen across the board. There's no reason why a private sector project cannot get stalled compared to a public sector project.
All right, Mr. Vyas, just a last question to you again, on the broader trends that you see both from your data and from other data sources. I think the last GDP number we got suggested that there is a slowdown in consumption demand. You alluded to it earlier as well. This is just as investment is starting to pick up. If that trend continues, doesn't bode well for sort of increased and stronger growth in the quarters ahead?
Lack of sufficient demand is the main reason why, in my opinion, investments ain't picking up. The lack of demand is seen in the capacity utilization numbers and even in the very low plant load factor of thermal power plants. Till capacity utilization does not come up, till pricing power of the farm sector does not come up. Mind you, farm prices are extremely low that just kills demand from a large rural segment of India. And that's the reason why loan waivers demand go up as they are. So I think very low prices for farm products, extremely low inflation is actually hurting demand. And that is hurting investment cycle pickup.
Mahesh Vyas, always a pleasure. Many thanks indeed for joining us with that perspective. That's a view from CMIE on declining in investments. The government has announced the share swap ratio for the merger of Bank of Baroda, Vijaya Bank and Dena Bank. Shareholders of the two smaller banks will get shares of Bank of Baroda. Neeraj is here to tell us how the valuations stack up as per the swap ratios, and more importantly, what does the market make of it? Neeraj.
Yeah, just the math for the stocks. Otherwise, I'm guessing Hira would have probably a lot more to say on this. But just the stock prices, and remember, the expectation was this morning that Bank of Baroda, whether or not it goes up is a separate thing, but the other two will definitely come off, and I think that's how it's played out as per script. BOB about 1.5% higher, but Dena Bank about 18% lower, and Vijaya Bank about 6 or 7% lower. Now, that merger valuation table, if that comes up on your screen, that's essentially the self-explanatory table, to be honest. The closing price as of trade yesterday, 119 rupees for BOB, 17.9 for Dena Bank, and 51.05. And based on these swap ratios, the price, the valuation price is 13.13 for Dena Bank and 47.97 for Vijaya Bank, which effectively, as per yesterday's closing price, meant a discount of 27% to the current market price existing yesterday for Dena Bank and about 6% for Vijaya Bank. So Vijaya Bank has fallen about 6% at par. Dena Bank as of now 18%, the discount 27%. You never know, it could fall a bit again yesterday. That's what at least dealers seem to be suggesting as well. And just frankly, if you look at what brokerages said as well, so JP Morgan, for example, believed that the merger swap ratio alleviated the pricing concerns that existed for Bank of Baroda. Since September 17th, when this merger was announced, the shares of Dena Bank had gone up about 12-13%. BOB had corrected about 17-18%, not just to do only with the merger, other factors too, but essentially Dena Bank had moved up. Even on that day of the announcement, Dena Bank and Vijaya Bank had moved up because everybody believed there's a rescue deal for them, and BOB had come off. Now, the bit of a reversal happening for both of these names. So Dena Bank down and Vijaya Bank down. Motilal Oswal, in their notes, say that while the swap ratio appears fair in respect of Dena Bank because of the multiple challenges faced by the bank, they believe that Vijaya Bank shareholders have nothing to gain from this merger. So that stock too is corrected on the basis of the valuations. The question mark only is whether that corrects more or not. But almost everybody that we spoke to said that they are not too confident of BOB moving up, but Dena Bank certainly will continue to remain under pressure until it reaches the parity price of about 13.5, which is the price that is calculated on the basis of the swap.
All right, Neer, thanks so much for those insights. Brokerages may not be too happy with how Dena Bank and Vijaya Bank have been valued, but the bank chiefs assure investors that the methodology followed is consistent with the trend and are confident of the growth prospects of the merged entity. Let's listen to what they had to say to Bloomberg Quint earlier.
after the announcement by the Government of India, each independent bank has appointed the valuer and then one provider of fairness opinions. And they have done almost 1 month. They worked independently and they worked together, and then finally they arrived at and they followed 3 methods, and appropriate weightage was given to all these 3 methods.
The immediate concern or the challenges will be, number one is IT integration, number two will be HR integration. And all the 3 managements are well prepared to tackle this issue. Government has initially also has assured appropriate capital, both for regulatory as well as for growth capital for the combined entity. So when capital is assured, number one, and number two, growth is possible because only few banks are in the market to lend, and this combined entity will be as active as it was before. And number three, addressing our resolution of NPAs. If these 3 points are taken care, the organization can give absolute challenge to any other bank operating in Indian sector.
The management of Vijaya Bank, Dena Bank. Reliance Jio may have sold more SIM cards than others in October, but the rise in active subscriber base actually fell to a 6-month low. The trend was slightly different for Airtel. Sumit Sarkar is here with some of those details in how the telecom war is playing out.
Well, TRA has come out with the subscriber database for the month of October 2018. Now, key trends that I could pick up from this database was that if you see the overall subscriber base, now that might have come down for Airtel in the month of October, but the company has been able to increase its number of active subscribers on its network. Now, if you see, and this has happened for the first time in 4 months now. This is a positive thing for the company, as active subscribers generally generate revenue for the company. Now, in the month of October, Airtel added nearly 33.7 lakh active subscribers for the first time in 4 months. However, this number is quite smaller when compared to that of Reliance Jio, which has added nearly 84.6 lakh active subscribers, partially aided by the launch of its Jio phone. Now, Vodafone Idea's active subscriber base fell by around 30.1 lakh, and this is for the 6th straight month where the company has seen a decline in its active subscriber number. In the last 6 months, the company has lost more than 2 crore active subscribers. Now, on the rural side, if you see, Reliance Jio was the only private player to add rural subscribers in the month of October 2018. Now, Jio's rural subscriber base increased by 64 lakh, that is nearly 61% of its net addition, which is the highest at least since June 2017. Lastly, though the overall subscriber addition has been a bit muted in the month of October, telecom operators are yet to see the full impact of the minimum recharge pack introduced by Airtel and Vodafone Idea and the new KYC norms mandated by Department of Telecommunications. The full impact of this will be seen in the month of November 2018.
All right. Lower crude prices may have put a smile on consumers' faces in the last 2 months of 2018. But the same can't be said about oil marketing companies which process the crude. That's because the inventory is usually bought earlier. Sumit Sarkar is here to put that into perspective as well. Sumit.
If you see the third quarter, that is expected to be weak for the oil marketing companies, and in fact there's a high probability that they might report losses in the third quarter of financial year 2019. Now, this is because of 2 reasons. Firstly, the sharp fall seen in crude prices, and second is the weak gross refining margins. Now, in the third quarter, crude averaged 9% lower compared to last quarter at close to $68.8 per barrel. Now, whenever crude prices have averaged lower compared to last quarter, all the 3 oil marketing companies have reported an inventory loss, and that is because oil refiners maintain an inventory, and if prices fall, refiners that bought the stock at higher prices end up selling it through retail outlets at a lower price. Now, because of the sharp fall in crude prices in Q3, they would report inventory losses in the third quarter of financial year 2019. Now, earlier, if you see in the first quarter of financial year 2018, when crude prices fell compared to last quarter, all the 3 oil marketing companies reported an inventory loss of close to 6,200 crore rupees. Now, second concern is around the oversupply amid tepid demand growth, which has also impacted the gross refining margins gross refining margins. Now, in fact, in the month of December, if you see, the gross refining margins went as low as $2.38 per barrel. However, for the quarter ended December, Singapore gross refining margin, that is the Asian benchmark, that averaged around $4.3 per barrel, its lowest since the third quarter of financial year 2014. So, a lower gross refining margin would mean that they would earn less on every barrel of processed crude. However, all was not bad for the state-owned oil marketing companies. This fall in crude prices at least helped them to recoup their losses in the marketing business. Now, despite the fact that government had asked them to bear that 1 rupee impact on the gross marketing margins, the margins that they have actually earned in the third quarter was higher compared to the second quarter. Now, in Q3, on sale of every litre of petrol and diesel, they earned 3.6 rupees and 3.2 rupees per litre. So this sharp rise seen in the gross marketing margin will definitely boost the marketing segment of the oil marketing companies, especially that of HPCL, or as sale of retail fuels contribute the most to its EBITDA. But however, a higher inventory loss and a lower refining profit is expected to bring down the overall profitability of the oil marketing companies.
Soumya, thank you for that. Let's move on now. This is the latest in the SR Steel insolvency. The Company Law Appellate Tribunal has directed the Ahmedabad bench of the NCLT to decide on the case at the earliest. The NCLAT was responding to a petition from a committee of creditors citing inordinate delays in the matter. Arpan Chaturvedi now joins us from Delhi. Arpan, what's the latest on this? What's transpired?
That's right. So if we go in the background of this case, the Supreme Court had allowed the bids. They have basically asked ArcelorMittal and New Metal, who were contesting in the Supreme Court, to clear their dues. Post that, we saw the COC, the ArcelorMittal, of course, had cleared their dues, and the COC in October had approved the bid by ArcelorMittal. After that, we saw in NCLT Ahmedabad some of the shareholders, including the promoters, approaching the NCLT against the insolvency process that was going on. And in that case, there has been 2 adjournments. Today in the NCLAT, that particular appeal was filed by the Committee of Creditors, who said that the NCLT Ahmedabad bench has been adjourning cases without giving any reasons, and the NCLAT today asked the NCLT Ahmedabad bench to clear these, to hear the matters and decide them at an early date. Which specific date they did not give, but of course they asked the COC that they should go back to the NCLT bench, and after, of course, the NCLAT has asked them to hear the case at an early date, and if that does not happen, they have given the liberty to the COC to approach them again for seeking an expeditious hearing by the court.
Thank you so much for that. The Reserve Bank of India voiced its concerns surrounding investments made by investors in liquid mutual funds. The regulator, in the wake of the IL&FS crisis, said that it said in its financial stability report that the entire liquidity risk was passed on to investors. This has not gone down too well with the mutual fund industry, who insists that the business model warrants such a pass-through. Sajid Mangat is joining us with the debate. Sajid.
That's right. If you look at the FSR, the RBI has come out with a statement saying that entire credit risk with respect to liquid and money market schemes have been passed through to the entire investors. And this is not the first time we are hearing this, because earlier in December we saw Uday Kotak also putting out a concern saying that there is infinite leverage which is there in mutual funds, and that gets passed on to the entire investor base, and so there is requirement. There may be a requirement of a capital or a reserve that needs to be put in for mutual funds, so that investors can be protected in some fashion. But the mutual fund industry is dismissing this claim, saying that the entire model of mutual funds is through pass-through, and they get a meager fees for that, and the entire returns are passed on to the customers. Likewise, entire credit risk gets passed on to the customers there. They're of the view that there are inbuilt checks and balances which have been put in by the regulator, which is SEBI, especially with respect to fair valuation for assets. The recently introduced side pocketing, which also allows to contain any contagion impact in case of there's a credit risk which comes in as part of ratings downgrade or so. So that limits the entire thing. And furthermore, they go on to say that there is a due diligence which has been done, and funds don't invest below AA category of paper. And so the onus is now on the regulator to ensure that that credit rating agencies do the job and ensure that the credit rating is reflective of the assets which are there. And especially in case of IL&FS, we've seen that the paper was a AAA paper, but it ended up on a default rating, and thereby creating this contagion. So the industry is very guarded with respect to this statement which has come from RBI. Harsha.
Saji, thank you so much for that. Let's move on and talk about Infibeam. The statutory auditors want to see the detailed report submitted by a third party on its merger with Avenues India Private Limited. SRBC and company had asked for an independent probe into the transaction about 9 months ago. According to Infibeam's filings with the exchanges, Aman Kapadia, who's gone through some of these filings, is here to tell us what this case is all about and what exactly is being probed. Aman.
Now, the timeline of events has been in the first quarter, SRBC and company asked to initiate an independent audit into company's merger and investigation and some other financial statement related matters. Company in the second quarter appointed an independent CA firm who investigated this matter, and as the company states, it has no material adverse observation in its report. Now, auditor is not satisfied with the report and has asked for a detailed report in the same. The management in communication with Bloomberg Quint has said the detailed report is still in the progress. Now, one of the issue can be the probe stems from the rupees 2,000 crore merger with Avenues India Private Limited. It was an all-share deal, and the valuation was done while that 133 crore rupees was valued for the company's net assets, which were the book assets of Avenues India Private Limited, net liabilities, while rupees 1865 crore rupees was allotted to the unidentified intangible assets, namely goodwill, software, trademark and customers. Although it's not clear if auditors' concern has stemmed from such high portion of intangibles, Infibeam has not revealed the specific details of the matter under probe. The auditors, SRBC and company, has said that pending investigation, it cannot comment on the impact it could have on company's financial for last financial year and half-yearly financial numbers of this year.
Thanks so much for that, Aman. Over to international news. Apple cut its first quarter revenue guidance for the first time in nearly 2 decades. CEO Tim Cook blamed the US-China trade war for the slowdown in demand. Bloomberg's Emily Chang reports.
Apple making an unprecedented move, cutting its revenue guidance for the current quarter in the middle of the quarter. Apple shares were halted as the company released a letter from Tim Cook to shareholders saying they were cutting revenue guidance to $84 billion for the current quarter. That is down from the original guidance, $89 to $93 billion, and the company placing the blame squarely on the economic environment in China, saying the slowdown there has been much more pronounced than the company had anticipated, that it impacted all of the product categories, iPad, iPhone, and Mac across the country. Apple also saying, however, that customers in general are not upgrading iPhones as quickly as they have in the past. So that is adding to the overall call here. The company said supply for some of the other products like AirPods, Apple Watch was constrained. This, of course, as the trade war between the United States and China is looming, as potential tariffs on the iPhone are looming. And this was perhaps the most telling line in Tim Cook's letter. He wrote, "We can't change macroeconomic conditions, but we are undertaking and accelerating other initiatives to improve our results." So to a certain extent, what Apple is blaming here is really out of Apple's control. So it'll certainly be interesting to see what the numbers ultimately are when the company does report earnings in a few weeks. Some would say it's still an $84 billion quarter, which is a big quarter. But as the company makes a transition to a services company, clearly there are trickier waters to navigate. Emily Chang, Bloomberg, San Francisco.
Out of time on the show. Thank you so much for joining us.
Lots more on Bloomberg Quint. Stay tuned.